Yeah.
Look who's here, Brian Belski, Chief Investment Strategist at BMO. Disappointing indicator on the service sector. What does that tell you about the market?
Not much, because, again, 50 is the major number from a longer-term perspective, and I'm hoping that this isn't one of these data points that those short-term traders out there try to jump on, because the economy is still expanding, and that's the bottom line.
Okay. However, you have changed your tune, haven't you? No, let me explain. I read about you in the Wall Street Journal this morning, that you have altered your forecast. You've downgraded your forecast just a little for 2019. What's the matter with you?
From a D sharp to a D flat, okay? I mean, we're not really changing the tune that much. We went from 3150 to 3000, and here's why. To attain a 3150 target after such a huge
this is down. This is S&P.
S&P 500 from 3150 to 3000. I think we're still at the higher end of the street with respect to my other compatriots. To achieve that type of move, especially considering the sell-off that we had in December, we have to see a powerful type of rally. Now, the numbers are for a big rally, though, however, because following a negative year, Stuart, since 1945, the stock market, as defined by the S&P 500, has averaged a 13.4% return following a year where we lose money. We've only lost money 6 out of the last 30 years. So this is a big deal that the market was negative last year. Now, clearly, we were humbled last year. We were more bullish than most people. And we, quite frankly, underestimated the amount of rhetoric and the power of emotion and innuendo that we think really drove stocks. We firmly believe that fundamentals were not in charge of the stock market in 2018.
And will they be in 2019?
We think so. I think the phrase that you want to think about is what should have happened in 2018 is going to happen in 2019, meaning more investment, fundamentals matter, earnings matter. And I think money's coming back to the United States, especially considering the volatility in other markets. We're all expecting this fancy global synchronized market and growth around the world, but we see a lot of volatility, not only political volatility, but earnings and fundamental volatility. And I think money's coming back to America because of that.
Okay. All of our viewers who've got a 401k or an IRA, 401ks in particular, 55 million people have a 401k.
Right.
This is the time when they can say, I want more in stocks or less in stocks. I want more in bonds, more in cash. Should they be staying in stocks? Because most of our viewers with a 401k are in the stock market. Should they stay there?
Absolutely, because at the end of the day, they're not going to be touching that money for several years. And the compound annual growth rate of the stock market is 9%. 8.6% to be clear, right? You can massively outperform bonds. I think you'd be doing yourself a great disservice selling now. You always want to buy when there's fear in the streets. In December, there was fear in the streets. And we downgraded our number, by the way, after the market rallied late in December. So we didn't do it until January 2nd.
Okay. What about people like me? We're of a great...
Well, you've been off for 2 weeks, so, you know, you're feeling good.
I'm talking about my 401k.
Yeah.
I mean, I'm an advanced age. I'm getting up there. So should I be moving out of stocks a little bit? You never know what's going to happen in that.
You shouldn't be, because I think what we fail to recognize is that bonds, we believe, are heading into negative real rates of return the next few years. As interest rates go up, their total return will be going down. We can talk about bonds being a more attractive portion of your portfolio because of where yields are. But remember, as yields go up, price goes down. And I think that many people forget about that. So the negative performance of bonds, I think, are going to have a very strong negative performance to balance.
We're positive now, Stu. We've turned positive.
Yeah, the market's turned positive. That could be weakness. But wait a second, that could be weakness in the service sector, which could mean that the Federal Reserve is not going to raise rates. It's dovish. Thank you.
This whole notion of bad news is good news, and here's the deal: fundamentals are improving, and that's the good news. And they're still very strong, and they're stable relative to the rest of the world. And I think that's what we need to focus on as investors.
All right, you bailed yourself out. Not bad. Thank you very much indeed, Mr. Belski.
Nice to see you. Welcome back.
See you later.